everyone. Thanks for joining us. This is our fourth quarter of 2025 market and strategy recap. I'm Paisley Nardini, the head of multi-asset solutions here at Simplify, and I'm joined by Jason England, who is our chief fixed income strategist and named portfolio manager on several of the strategies that we'll discuss today. A little bit of housekeeping before we jump into the good stuff. There is a Q&A chat. If you guys have questions throughout, please post those. We will field them towards the end of today's conversation. And then just as a reminder, today's discussion is for informative and educational purposes, not to be construed as financial advice. And all of us here at Simplify are happy to help. So please reach out after today's webinar if you have questions on the firm, the strategy, or anything else. So thank you again for joining us. And we will jump right in. So I'm going to share my screen. And Jason, will you give me a nod when you can see my screen?
Yep.
You got it? Okay, cool. That's
Oh,
Jason.
no, not yet. So there it is. Where we go.
There we are. Okay, let's go. So maybe for starters, just wanted to actually start with the state of Simplify. I think this quarterly webinar is always interesting because it's more of a year-end recap as well. So I thought it might be helpful to give everybody a snapshot of where we are today. Total AUM is just north of 12.2 billion as of today. We've continued to see strong growth. We've continued to bring innovative strategies to market in response to our client inquiries. I think what ultimately we look to provide here, very much the belief of active management. And oftentimes there's problems in the marketplace that some of the traditional ETFs aren't able to solve for. And that's where Simplify seeks to kind of fill a gap. So what you'll see here is currently we have 36 strategies, all in daily liquid ETF wrappers on our shelf. 15 of those strategies have assets under management north of 100 million, and 3 of our strategies now have assets under management north of a billion. And I just wanted to share this. It really speaks to not only the breadth, but also the depth of our capabilities, and that we continue to see momentum and growth in some of these flagship areas of the market. Thinking back on the last quarter, some of the new exciting launches that we brought to market. The first near and dear to my heart is our return stacking version of CTA. So we'll talk about CTA later in today's conversation when we highlight some of our alternative funds. But in December of this last year, we launched a CTA plus S&P 500. So this is going to give each investor 200% exposure with $1 of capital invested. So each dollar will give you $1 to CTA, which is our active managed futures trend following strategy, and $1 of exposure to the S&P. Why did we launch this? Ultimately, the belief of liquid alternatives and needing diversifiers in a portfolio, I think, is a rising trend in the marketplace. But oftentimes clients don't want to sacrifice the equity beta because they believe equity markets will continue to run. Another reason for the return stacking type concept is that line item risk, right? So with liquid alternatives, you are seeking low correlation. And when you have strong equity markets, oftentimes clients might wonder why that single line item had low returns when the S&P delivered strong returns. So this really ultimately provides beta with the diversification on top of it, so you can kind of have your cake and eat it too. And we launched that in early December. So super excited seeing some early adoption of that, and really just builds our stable of strategies that we've partnered with Aldis Partners on. The other strategy we launched in the fourth quarter is another part of our growing suite of these high equity income solutions that we've brought to market. We talked last quarter about some of our flagships being SBAR, which is our 30 barrier, currently distributing low double-digit returns from a yield perspective. And then also we have XV, which is our target 15 distribution barrier product. In the fourth quarter, we launched another version of this. It's a higher octane. This is not going to be for everyone, but this is a 25% target distribution yield. That's the Roman numeral there, XXV. And this is really for those clients that are seeking high levels of distribution income and are willing to take on more individual equity risks. So in order to deliver or achieve these higher levels of distribution, we are writing options on individual equities. So that's, again, both of these strategies are growing our stable, our suite of some existing product lineup, and a continuation of some of that success that we've already seen. Maybe pivoting to more of our flagship, longer standing track records you'll see on the right side of the screen. is the collection of our strategies which have high ratings from Morningstar. You'll see at the top our core bond strategy, which is Ag H. Jason will speak to that in a moment, is a five-star rated fund as of the end of the year. Very proud of that. Really strong performance despite some of the early volatility we saw in 2025. And then in addition, we have four-star rating for our high yield fund, CDX, our managed future strategy, CTA, our healthcare, which is an active discretionary strategy managed by Mike Taylor, that all of the proceeds go to Susan G. Komen. That's continued to deliver really strong alpha within its category. So really proud of that, not only from a performance, but also in the benefits that it's giving to breast cancer research. And then lastly is our hedged equity solution we'll talk about later today as well, four-star rating, and continues to build a long track record. So really proud of the growth that we've seen, again, growing and building a further investor base for some of these longer standing flagship strategies that continue to be category leading and then continuing to bring innovative solutions to market where we can. So we're going to do a little quick macro background. Some of you have probably already noticed, and I said this last quarter, I said Mike would be back with us. As we know, Mike is a busy guy. I'm actually going to meet up with him later in Seattle for some client meetings and a CFA event. He's sorry that he wasn't able to join, but Jason and I are going to tackle this in his absence. As I think about 2026, it's been a bit of a head scratcher. I think continually reading headlines that markets are doom and gloom and they're overvalued and credit spreads are so tight and there's all this geopolitical risk. When is the rug going to get pulled out from under us? And the markets continue to show resiliency. So entering 2026, the way that at least I'm personally viewing this is how can we continue to participate in the market in a prudent fashion? So this isn't, run for the hills, put everything in cash. This is the end of the bull market. I think there's plenty of catalysts that will continue. So how can we stay in the market, continue to build on the last couple of years, which have been really strong, but do so in a more prudent way without taking chips off the table? So a couple of themes that we'll talk about today is making sure that you have hedges where it is not cost prohibitive or it doesn't meaningfully sacrifice returns. And we'll talk about some examples of that. We'll also talk about ways to be dynamic and flexible. I think that's a recurring theme is this set it and forget it type portfolio approach might not be what we need over the next decade as markets are faster moving. There's more geopolitical shocks, and there's a lot of volatility across both equities and fixed income. And then lastly, the star of the show, we'll bring in Jason here in a second. Our bonds back. We spent the last several years talking about how at least many headlines did. The 60/40 is dead because bonds are no longer that ballast in the portfolio, which was very much true from 2022 through 2024. 2025, I think we actually saw bonds show up in a meaningful way again. So as we enter this year, what's in store for us from a fixed income portfolio, which is why we wanted to invite Jason, our subject matter expert, to share some of his insights, thoughts on the Fed macro backdrop, and then he'll get into some more of the strategy specifics later in today's discussion. So, Jason, what's going on in bonds?
Yeah, sure. Thanks for that setup there, Paisley. Well done. Yeah, I mean, I think, to answer the question simply, yes, bonds are back. If you look at, 2025, some strong numbers. Obviously bonds aren't going to be the double-digit type returns in the treasury space like you get maybe in equity space. But treasuries, the index over 6% last year. The aggregate bond index was over 7%. So yeah, bonds are back to an extent. But there was a challenging period last year. Obviously back in April we saw the worst of worst when you talk about rate fall. But going in, we're reflecting back on fourth quarter, and the way you kind of look at the fourth quarter is, obviously the Fed eased three more times, another 75 basis points. So they resumed easing again in September, right before fourth quarter. And you really didn't see much movement in bonds as far as lower rates. You saw them actually kind of the 2 year was up a little bit. Tens and thirties were up a little bit more than that. So you really saw range-bound markets, and that's kind of the narrative that we had going into this year. And really, the one thing that you look at, and these charts highlighted, is the two things in fixed income that you look at right now is rate vol has come down a lot. So even though rates have stayed a little higher, not quite the peaks we saw back in early April of last year, but you've seen rates kind of stabilize into this range, maybe a little higher, but rate vol has come down drastically. If you look at the move index, it was as low as 60, last week. Somewhere back in the mid 60s now. And then the other part of fixed income to me that has been the most complacent over the last year now, and even coming into this year now, we've seen it is credit spreads. Whether you're looking at high yield here, in the 260s, or if you look at, really look at investment grade, even, 5-year CDX and investment grade is below 50. So very complacent to me, considering all of the uncertainty that we've had in the rates market. When you look at really the pressure that you've felt with all these geopolitical tensions, Fed independence, fiscal dominance, all these things that really kind of impact the rate markets, you really haven't seen much rate vol or credit spread widening that you would think you would normally see in this type of environment. Markets don't like uncertainty, and we've seen a lot of it recently, and obviously well into, starting this week with some of the comments around Greenland. But really, the fourth quarter was kind of a mixed bag as far as rates staying range bound. We saw 75 basis points easing, as I said, but you've kind of stayed in that range bound mode in rates, and we've kind of broke through it a little bit in these some of the more recent tight ranges we had, late Friday and early this week. We kind of broke the upper end higher in those just because of some of the comments around the next Fed chair. Hassett more dovish leaning, maybe not being somebody Trump wants to appoint, as well as, now these comments around Greenland and taking it over. And then you also have, the subpoena to the Fed, as well as the Lisa Cook Supreme Court hearing today. So a lot of uncertainty, which leads me to believe, the outlook going forward in rates, more range-bound markets. Ranges may set higher or lower throughout the year, but really there's two dynamics going on. In the front end, you're going to feel some pressure for rates to go lower. Obviously, the administration wants that. The Fed, trying to push them lower. Whether or not, we get a dovish leaning chair going forward, it's still going to be a committee that's going to have to decide that. So front end pressure, but then the back end really kind of staying elevated around these, whether it's sticky inflation, still running above the 2% target for the Fed, whether you're looking at, fiscal dominance with the growth of our deficit we have, as well as the Fed independence I spoke to. So that dynamic leads to believe that, you're still going to see some of that rates moving around. Hopefully not as volatile as we saw, like I said, early part of last year, but kind of staying in that range bound, which sets up for attractiveness in some of the structural alpha type opportunities that we have in our strategies in fixed income, especially when you're talking option income on treasury market, trying to take advantage of that and harvest some of that volatility. So there are opportunities. So I would say, yes, bonds are back. The outlook could be a little uncertain, but the key here is active management and trying to extract, as much as you can out of the fixed income market. The other thing is I'll highlight is, back when bonds were, out of favor when you're in 22, 23, and 24, we had low yields to come off of. And so when they were aggressively hiking, that was a detriment to bonds. But now we have higher yields, even though they have come down, especially in the money market space. We've only twice in the last two decades had over 3% in money market yields, and we have that now today. Could they come down some more? Yes, but the outlook more for the Fed is probably more gradual easing. We've probably seen the last hike or the last cut, excuse me, in the Jerome Powell tenure. His tenure, is up in May as chair. We likely won't get the first cut of this year until somewhere in June and July. So there's a lot there. So hopefully that gives you a little frame of not only what happened in Q4, but also the outlook heading forward in the rates market. And I think although it may be some challenges to it, I think there are opportunities, especially in active management.
We don't think Powell's going to hike just to stick it to him on his way out.
They did bring that up on CNBC today about
Yeah.
that is like, there was comments about him showing up to the hearing today, and one of the, experts out there, economists, said that's a form of being bullying on
Yeah.
the point. And it's like, really, I think the only bullying that we've seen is the other way around. But no, I think he's going to do what's right, and I think what's right is to be this gradual, easy. Yeah, are they still a little restrictive and a little too high? I think so. I think they need to get to a more neutral rate, probably closer, to 3%. But in the meantime, I think because of some of those dynamics and backdrops and the uncertainty, they want to be careful on the way down. And I think that's why we've seen this, two phases of this easing policy, has been they did 100 at the end of 2024, and they did another 75 basis points at the end of
Yeah.
2025. So you put it together, they come down quite away from that 5.5% that they hit, back in 23, when they had to really try to, boost the rate to try to combat the high inflation that we saw.
Yeah, one thing too that I'm just keeping in mind, and I agree with you, I think Powell's going to do what the data says because that's their mandate. And employment, I think, gives them enough ammo to continue to cut gradually. And I think what we've seen just from the true inflation numbers, I know that's another way to look at the assessment of the level of inflation, that fell off a cliff in December and into January. I think the recent print on true inflation is closer to 1.5%, right? And so they always claim that the BLS data is at a lag, backward looking a bit and not as relevant or timely. And so if that number does kind of port through to the ultimate PCE numbers that they're posting in the next couple months, that would give plenty of ammo for them to continue to cut. So that could be another catalyst or tailwind in bonds. But I think irrespective, right? We don't have the crystal ball, is that volatility remains low, markets feel complacent, and yet there's all of these factors at play that warrant having some views that are expressed through active management just to ensure that you are nimble and able to take advantage and avoid some of those landmines that we might run into. So, TBD, but this is super helpful just to kind of tee us up what we'll talk about here in a couple minutes and some of the strategy specifics. The next couple slides will be pretty quick. Thinking about how to prudently participate in the markets. And this is something that I think we're really proud of at Simplify is ways that we've embedded very attractive and cost-effective ways to think about hedging. Because oftentimes if you hedge your portfolio, it comes at a cost. And oftentimes that just erodes your long-term return. So two strategies that I wanted to mention here, which we can unpack a little bit more, is our hedged equity strategy. I think this is becoming more and more commonplace in both the traditional part of a portfolio alongside equities and also in a lot of alternative sleeves. Our clients are utilizing a hedged equity solution. Ultimately, we're looking at performance relative often to a 60/40 portfolio. We'll talk about the strategy more, but you can see here, and this is just in like the tariff tantrum environment, the importance of having some type of diversified semi-hedge type solution so that your portfolios aren't experiencing that full drawdown. So again, just a snapshot of some of the sell-off we saw in early 2025 on the left there and how hedged equity and white held up better than just the S&P 500. And then on the second chart, you'll see here is our high yield strategy. And this is also in that tariff tantrum period and the importance of having our embedded proprietary hedge within our high yield strategy as well as spreads started to blow out, just really able to weather the storm. And I think thinking about where we are today, these types of environments or scenarios could come to fruition again. I mean, the tariff tantrum wasn't really until April, and so that mid-February through March period last year was just kind of some market turbulence. And so thinking about ways to protect the portfolio to ensure you can weather those is how what we're here to help with. And then lastly, this is definitely a growing theme in portfolios is active management within bonds, even some of the active, more risk mitigation in equities, but especially as it relates to alternatives, thinking about ways to be quite agile, to navigate and be flexible as we're getting this information from geopolitical news, supply demand mismatch. I mean, right now, I think nat gas is up 30% in the last couple days because of the cold spell coming through in the US. And so just being able to take advantage of that. I mentioned because some of our strategies invest in natural gas and commodity and managed future space. Thinking about ways to balance risks, trend following is a really easy way to think about having a low correlation strategy that is quite adaptive to all of those things I just mentioned. And then the last category I mentioned here is unconstrained. So we talk a lot about fixed income, but being able to go into different sectors as opportunities present themselves, underweight or overweight. We just really believe in the importance of active management, not only for upside participation, but really to navigate and protect on the downside. So with that, we're going to dive into some of these strategy specifics. We're going to kick off with fixed income. So I'll hand it back to Jason here, but this is the list of strategies that we wanted to cover today. We think all of these are relevant, resonating in our client conversations, and ones that we want to make sure are on your radar. So, Jason, I'll hand the mic back to you and let's run through the fixed income and tell me when you want me to advance to the next slide.
Yeah, sure. So I think this is key right here is, as I mentioned, even though rates have been uncertain and kind of, range bound, and even though rate volatility's come down, treasury option writing programs, structural alpha is what we're talking about here in the treasury market, and taking advantage of even when you have some lower rate vol like we've seen. If you look at the chart there, the move index is come down quite a bit from the peaks back in April. But the worst case scenario we saw in April, but then coming out of that, the risk event that you see, just like when you have one with your insurance policies, it's the premiums after are always going to go up. And this is what we saw here. So selling options into this type of environment was very attractive because premiums on the options went higher. You're collecting more, obviously premium that you're passing back through in your yield. And so really that what we saw is not only did rate vol come down, rates stayed a little higher, but they reset, into a range, and we pretty much have stayed somewhat range bound. Like I said, you've got a lot of these risk events pulling it one way or the other. You want the dovish front end trying to pull down, but then you got the back end that's really trying to stay elevated somewhat. So on these geopolitical, Fed independence, all these headlines, they ratchet rates around. But what we've seen is they've stayed somewhat range bound and they revert to the mean in the middle of that range. And as long as you're seeing that, that's when the opportunity set is really good for these option selling strategies on treasuries. And we saw that, once we got the risk event through Q3 and Q4, especially Q4, they really stabilized, rate vol came down, and you sat in the middle of that range and you just collect those premiums. And then you also have a little bit of now layering your strikes, diversifying your strikes as well, and short dated options here. So you're only talking 1 to 2 months that you're rolling them out and diversifying them. So it sets up for an environment that we've seen, and we think will persist into 2026 because a lot of what we saw in Q4 kind of leading into, Q1 of this year, you're getting really the same backdrop where the uncertainty around Fed, the uncertainty around, fiscal dominance and all that is really going to create range-bound markets. And we've seen it already early this year. Although we broke a little bit on the range recently, that range was so tight. We're talking the 10-year was trading in less than a 10 basis point range over the last 5 weeks. Call it back to mid-December. So we're setting strikes wider. We're not trying to capture a range that tight. So that really shows you how you can optimize and take advantage of this type of environment on treasury options. So I think this is something that we do in a couple of our strategies. We'll go into deeper here. So yeah, the first one is Buck, which is really looking at trying to, it's a yield enhanced T-bill fund where the collateral is in money market type securities, where we're really looking to try to optimize the yield in here by doing this option treasury strategy on top of it. Option income, like I said, after a risk event is very attractive. We've seen it happen, and now with these range-bound markets, and the thing here is limited to no credit risk. Really, you're really only looking at, the underlying securities are all government-sponsored money market type securities, and then the options that we're selling are on treasury futures. So looking at that, you're taking out of the play that complacency I talked about in credit markets. So it's a way to diversify away from credit right now if you want to find some other areas of attractive yield. We've seen a lot of clients, especially in the ultra short space, don't want to press down the capital structure to get more yield, but here you can get somewhere, attractive yields, in the, mid single digits, almost at times looking at, high yield type with little to no credit risk, as I said. So that's the first opportunity set, that we kind of see in this structural alpha sure.
Maybe one thing I would mention too, just because of the vol event we saw in April, I think a lot of investors were shocked because a lot of the volatility was in the longer end of the curve. And although this does fit within more of the short-term bond space because of the underlying cash management, the duration profile is quite low. As Jason mentioned, as we're writing these options, they are on longer dated treasuries. And so that was what caused a lot of that volatility. So just wanted to highlight that one of the more technical nuances of the strategy, but it helps explain why there was so much volatility back in April, which, as we show here in the fourth quarter of this year, strong outperformance relative to bills. But I think it's always helpful just to understand all the risks in the strategy as well.
Yeah, it's a great point, and I think that's something that was maybe underappreciated at the time is that the area that we're targeting is long bond futures, which is the 20-year point of the curve that we're selling options on these futures even though the overall duration of the portfolio, because these are out of the money options, it's going to be, targeting 1 year or less because really your duration is getting made up of the underlying collateral that you're holding in these short dated money market type securities. Um, but as you get closer to the strikes, and that's what we saw back in that event, that's when you start getting the deltas are higher and you trade more like the underlying. And that's why you would see more of that volatility, as you mentioned, Paisley. Yeah, so here is the next one, Egg H. And this is, like I said, the other one was a yield enhanced T-bill fund. Egg H is our yield enhanced aggregate bond fund. We start with a beta position of the AGG ETF. That's just getting our beta exposure. And now we're looking to do things in here where we're trying to, more efficient option writing and curve positioning. And really that's the tenements of what we're trying to do. And obviously the option selling program on treasuries that I've discussed over the last two slides is a big part of what the return profile and yield profile was for this strategy last year, and it sets up well into next year. And then also, what the one thing I probably didn't mention I should have during the overview of the rates market is the one thing we did see over the last year is the curve start to normalize and re-steepen. Obviously, the Fed has been moving the front end down, but the back end, as I said, has been elevated. So there's been steepening positions, and we do have a small steepener position in right now as well. So trying to take advantage of that, I think that's the one area where you're going to see, even if the Fed's more gradual and the back end stays elevated, you're still going to see the curve continue to steepen and normalize. So that's another area focused in Egg H. And then other areas that over time that, if we feel like there's opportunity sets outside of the aggregate bond index, or if there's opportunities that are part of it that we want to over or underweight, we will do that. And so right now we have a small, relative value on tips, real yields looks attractive. We have a small position in that is right now. And then the other areas, like I said, credit's been so complacent. We have a small percentage by owning the ag in the, IG part of that is about, call it 20, 25% of the ag is in investment grade credit. And we put on credit default swap hedge where we're protecting that, as we see fit right now with the complacency or the very tight, historically tight credit spread. So those are kind of shows the one thing that we will tell you that with Egg H that diversifies or is different than most of the other core bond funds out there is most core bond funds are going to take, the index and try to over underweight it with duration, which is in a, directional calls, which we're not trying to do here, or they're going to over and underweight it on spread product, meaning investment grade credit, high yield credit, non-agency mortgages. That's another area that we're not doing either. So at the bare minimum, this is a good diversifier away from what others are doing in this space. And then the added benefit of this treasury income component that has really performed well, over the back half of last year, and we feel still has the opportunity set going into this year as well. So there is that differentiator as well as the potential for more yield and total return going forward in a strategy like this.
And I would just echo Jason's last comment. Many of our investors do pair this naturally with some of the active fixed income managers that they've selected that are more credit focused, individual credit research, And again, that's not a bad thing. That's a great way to add alpha actively in the fixed income space. So this becomes a natural extension of that from a diversification standpoint. And then, of course, the absolute return just within its category. There's a reason Morningstar assigned it a 5-star rating. Really strong, attractive absolute return. So kind of checks all the boxes. And again, I think because of that rate vol that we got through last year, looks really attractive over its life.
Okay, yeah. Now MTBA is one of my favorite strategies. I mean, it's one of those ones where you're not hitting home runs, you're hitting, singles and doubles. It's one of our biggest, well, actually the biggest fixed income ETF we have. And what I like about it so much is it's really just a simple strategy. If you want attractive yield with little to no credit risk, and the reason there's little to no credit risk is because we're buying agency MBS in there via the TBA market. Fannie, Freddie, if one of those go under, we've got bigger issues in the world that you're not worried about, the small allocation in your fixed income portfolio. But the beauty is that we're buying the newer issued, higher coupon, thus higher yield to maturity securities in there. So you're looking at average coupons that, almost twice what the index has, because the index is owning those legacy 2.5, 3% mortgages that, a lot of the boomer generation and others have out there that you're not refinancing them with the mortgage rate. It's come down, from 7, but it's still slightly over 6%. So you're not going to refinance your mortgage with those. So really taking advantage of an opportunity here that, nobody else was doing in the ETF format by trying to squeeze, some extra yield. And the other thing to add to it is by having more yield, or by not only have more yield, these newer issue coupons are closer to the mortgage rate. So the prepayment risk are higher on them, so they have shorter duration because they would be refinanced sooner than a 2.5 or 3% mortgage. If you're talking anywhere from 5% to 6% mortgages that we hold in here. So less duration obviously means less interest rate sensitivity, so less volatility in the portfolio. And that's why I say hitting singles and doubles, you're talking a decent yield. Not talking as high as we were getting in maybe Buck or Egg H, but still an attractive yield over 5% that is not hitting home runs, but you're also very safe feeling with the little to no credit risk in it. So you're not worried about any spread widening that potentially could happen on the any of these geopolitical or any of these type of events that we've seen, more recently in the market.
Quick question, Jason. I know for a while, the spread of agency mortgages over IG credit was quite attractive. We had quite a few clients and investors that were overweighting via MTBA relative to IG credit in their portfolio. I know some of that spread compression has occurred, especially in the last maybe couple weeks with some of this talk of GSEs buying up mortgages. But what's your take on that from a spread perspective? How attractive do agency mortgages look right now relative to IG credit?
Yeah, that's a great question. So it has come in a lot. We were talking, early part of last year, spreads were about in the 120 to 140 basis points above treasuries. Now they've come down to more their all-time average, somewhere around 75 basis points. But when you look at IG credit, the 5-year CDX is below 50 basis points. There still is a decent advantage over IG credit. It just isn't as, great as it was, at some points, obviously heading into last year and even into the middle to, Q3 of last year. So we have seen some spread compression, but it's still a little bit, more attractive than an
Okay.
investment grade credit right now.
Okay. That's helpful. So maybe we can pivot then to talk a little about credit, and I might have some comments on CDX as well if you want to tee us up.
Yeah, I think that the key here is you kind of highlighted on the slide earlier, and that I've been kind of saying throughout this whole fixed income overview is to me, I've been a credit investor most of my 30 plus year career, and you're just seeing a very complacent market. We saw it yesterday when we started getting news around Greenland and that, and the equity sold off and rates, started to spike and broke out of the recent ranges, but credit barely moved. Credit spreads barely moved. You still have historically tight levels, like I said, in investment grade. 5-year CDX is below 50. 5-year high yield CDX is below 300. So you've really seen this complacent market. So how do you want to play it? And I think that's why you set it up really well at the beginning is hedge is your friend this year. And this is where we have a strategy like this that we feel like the built-in hedge, and obviously it's been detrimental over the back half of the year because credit spreads keep going tighter. But you saw when you had a vol event where spreads widened back in April, and like you said, leading in February into April, when you saw the widening, you saw the benefit of having this built-in credit hedge and how it not only cushions your portfolio, but the benefit of being a positive carry hedge. Most credit hedges out there are negative carry, and we do and have the ability to apply some of those, but the Q minus J or quality minus Junkin hedge here is slightly positive. So by having it in your portfolio, you're not bleeding out the P&L waiting for this risk event like we saw back in April.
Yeah, and I think where this type of strategy really resonates for some of our larger investors who have set allocations within their asset allocation that require high yield and can't eliminate it from the portfolio, this becomes a slam dunk in the sense that you can stay in the market and be prudent in the way that you're accessing despite historically tight spreads. And then also too, I mean, you're still getting a really attractive total return. Default rates are extremely low. So even if we do see some spread widening, not only will CDX significantly outperform, but it's unlikely to see, a massive wave of defaults. So I think this strategy is positioned really nicely, as you mentioned, and just want to, of course, highlight when we do have periods of underperformance. Fourth quarter for CDX was challenged because of that hedge that's embedded and because spreads continued to tighten. But it did not behave in a way that was unexpected. It behaved exactly as expected based on where credit spreads tightened too. And the last thing I might mention, for those of you that are familiar with CDX, either currently invested or have taken a look at it, some enhancements were made to CDX in the fourth quarter via Mike Green's passive research. And so that quality minus junk hedge that we implement here in CDX, some of the factors were have been enhanced or evolved to incorporate some of his research on passive. So we have a lot more information. Happy to share. Please reach out. But this is another example of a systematic type strategy where through our oversight and the research ongoing behind the scenes, we can constantly enhance and evolve our strategies to keep up with the market and kind of digest new information. So we are very confident that when spreads do widen, because they will eventually, to what extent, unclear, CDX will kind of pull away from the pack again as it did kind of earlier in 2025. So that is all for the fixed income session. The one thing I wanted to say, Jason will stay on here, of course. That was kind of the end of the fixed income section, though. But Jason does a Rates on the Run podcast for us whenever there's a Fed meeting. So make sure to go to our YouTube channel and check those out. He kind of gives a state of the markets as soon as the rate commentary comes out. So follow along and make sure you don't miss that. Just wanted to give you a little plug, Jason.
Yeah, thanks for that. It's actually next Wednesday is Fed Day, so that will be the next
Perfect.
one.
All right, next Wednesday, Jason will be live. So let's jump over to talk about some of our alternatives. I know oftentimes Simplify is branded as an alternative firm, and yes, of course we are, but we have so much to offer beyond just the traditional alts that we think of. It's alternative ways of accessing fixed income or equity beta. But I think we do have some of the most innovative, unique strategies in liquid alternatives. And Foxy is one of those. So this is a strategy that was launched earlier in 2025. The brains behind this and the portfolio manager is Ken Miller, who manages quite a few of our strategies on desk here. And he'd been running some of this currency strategy and some of our other fund to fund type solutions here at Simplify. So we finally launched his own standalone currency strategy. It is long short. And then I would say it's been a unicorn of sorts. So I think we had high hopes for it, but it's more than exceeded. So I'll give a quick background on some of the results before I talk about the strategy itself. But we launched in February of last year. Through the end of 2025, Foxy delivered about 14.5% total return, so equity-like returns. which is incredible in a year where a lot of liquid alternatives saw a lot of headwinds and were not able to keep up. Oftentimes, in order to deliver those types of total return, that means you have high beta to the equity market, when in fact, Foxy's primary objective in the alts category is to have a lower correlation to beta. And so the correlation since we launched has been zero point 0.4 to the S&P 500. So many would consider that a lower correlation. Fits nicely within an alternative sleeve and about zero point 0.1 correlation to aggregate bond market. So already two objectives of attractive total return, low correlation to stocks and bonds. And then the third pillar, which is why I'm calling this a unicorn of strategies, is that because of its carry focus, and I'll talk about that in a moment, the distribution rate on Foxy is also makes it a really nice complement to any income portfolios. So we have monthly distributions on Foxy. The current distribution rate as of year end is 8.5% roughly, which compares to SEC yield of about 3.25% or cash. So really attractive from total return, diversification, and yield. And so this has become a kind of a core tenet in many of our kind of multi-asset model portfolios that we build for our clients. What you'll see on the chart here is Foxy strategy is the white line. This goes back to the inception, which was early February of 2025. The yellow dotted line right next to it is the S&P 500. So you can see for much of 2025 and all through kind of the tariff tantrum, Foxy was kind of neck and neck or outperforming the S&P 500. Again, that's not its objective. That just really speaks to the attractive total return profile. The red line is the aggregate bond index, and then the orange dotted line at the bottom there is a reference benchmark, which is the Bloomberg carry strategy. So Foxy is really thinking about how do we harvest carry within both emerging market and developed market currencies. The unique component of this, however, is that it's US dollar neutral. And so most currency strategies and ETFs, especially that are on the market, are either for or against the US dollar. Obviously, a very polarizing topic. I'm sure many of you on the phone or many of you that are listening today are having those conversations with your clients. They either want to be for the dollar, against the dollar in their portfolio. The beauty of this is that it's neutral to US dollar. It's really focusing on how do you harvest the carry profile or the yield that can be offered in emerging and developed currencies. So emerging market, we're going long and short pairs currencies, short the currencies that have lower yields, long the currencies that have higher yields. And then in the developed basket, it's slightly different approach, still focused on yield or carry, but overweighting the developed market currencies that have higher yielding momentum. So the ones that are starting to increase their yield, and then shorting the currencies in developed markets that are seeing negative momentum in their yield profile. And so, all in all, I think this is a really attractive opportunity to bring a diversified source in a liquid alternative wrapper. Again, this is an ETF, no K1, daily liquid, and really checks all of those boxes, I think, of any advisor I've met that has yield, return, and diversification. So, really excited about this. Came out of the gate really strong. And kudos to Ken Miller for delivering us a really attractive strategy. CTA. So I'll try not to get too excited. This is my baby here, but it's been an interesting year for trend following. Fourth quarter was a kind of an extension of that. Obviously, tariff tantrum was difficult for many markets, but trend following, if you think about what is the common pitfall, it's that trend is your friend until it ends. And any kind of those big geopolitical shocks, news that hits the market, tariffs, especially because we're investing in commodities, many underlying commodity contracts in any managed futures trend following strategy were subject to getting whipsawed, and we were not immune to that. At its core, the purpose or kind of the key objective of having trend following in the portfolio is one of the most capital efficient diversifiers you can think about allocating to. So you'll see here on the far right, correlation to large cap equities since we launched back in 2022 has been negative zero point 0.2. There's very few strategies on the marketplace that have a negative correlation to US equities. In addition to that, the ability to provide a attractive total return. So you'll see about 8.3% annualized return in the strategy with a negative correlation. So that is kind of the key objective here. And the visual that I've shared on the screen, I think really encapsulates why investing in trend following is attractive in a total portfolio construct. Simplify CTA strategy is the kind of rust orange color. And then the blue line is a 60/40 portfolio. And ultimately, you'll see the zig and the zag pattern. This couldn't have worked out more nicely from a visual representation. This is actual live since inception results. The key benefit here, when that blue line starts to zag, the orange line zigs. And that's really just showing the benefit of having this offsetting diversified exposure. Ultimately, when you put trend following in a portfolio next to your stocks and bonds, it's just going to help smooth when those traditional assets kind of hit the bumps in the road and see those drawdowns. So CTA has delivered as intended. It is an unconstrained, more active approach. We've partnered with Altus Partners based out of the UK, who runs a hedge fund based on like the same proprietary model that we get access to. And speaking of enhancements, I mentioned CDX, our high yield bond fund, had some enhancements in the fourth quarter. CTA did as well. As CTA has grown, we nearly tripled assets under management during 2025, and thinking proactively of how we can continue to deliver value to our clients in the form of alpha and diversification meant that we had to expand the list of markets that we trade in. So CTA is still entirely focused on interest rate and commodity futures, but moving beyond just North America, we've now entered into markets in developed Europe and the UK, in both interest rates and commodities. So just a larger toolkit. We now have over 50 markets from which CTA can trade in on a daily basis. For those of you that are also familiar with its sister strategy, which is the commodity only version, which is ticker on that is hard. Hard also expanded its list of markets that it's able to trade in into Europe and UK as well. So wanted to highlight that. It'll be an interesting year for trend following. I think we have a lot of tailwinds, but more geopolitical shocks, I think, will make this definitely something to keep on your radar as we enter 2026.
And I would be remiss not to give a plug for you either because I watch them. Your What's Trending in CTA with Charlie, and I think it just shows when you watch them how in line we are with the our sub advisor on that, and how you guys work well together. And I know, like you've said in the past, he's very transparent PM who loves to go on client calls. So take advantage of him and Paisley when you can, because I think it really helps dig into the strategy more when you watch the videos or get on a client call with them.
Yeah, thank you for mentioning that. I think you're spot on. Altus Partners is so accessible. We want to increase the transparency. Trend following tends to get this stigma of being a black box because it's an algorithm and it's rules based. So those monthly videos also on our YouTube channel seek to just provide full transparency, and we are always here to answer any questions. So thank you for mentioning that, Jason. And then lastly, we would be remiss not to mention some of our equity and equity income strategies. I mentioned at the onset thinking about ways to prudently participate in the market. I think after 3 years now of a bull market run, I'm still optimistic we have more upside in equity markets this year. But there's plenty of catalysts that could kind of knock that off its feet. So how do you stay prudently in the market in a way that allows you to sleep at night, makes your clients comfortable? And that's where our hedged equity strategy comes to market. For those of you that are familiar, essentially putting a protection zone anywhere from down 5 to down 20% in the S&P 500, you'll be protected. So anything below -20, if markets are down 30%, you would experience the downside of that, of course. But really that protection zone of down 5 to down 20%, which is typically what we see in an average year for an equity market drawdown. So oftentimes full protection on that. And what what we're doing here is we're accessing S&P 500 beta through a low-cost passive ETF and then applying a costless collar on top of that. And costless means that the cost for us to hedge and provide that protection zone is then financed on the offside so that we can kind of fully cover that cost from a performance perspective. So what we're doing here is buying a 3-month 5% out of the money put option. So that's giving you that first leg down for protection. And that actually is quite expensive, of course, because that means you'd be protected below 5% drawdown. So in order to finance that on the opposing side, we have two contracts that we're entering. One is on the far left, which is step 2, where we're selling, excuse me, a 3-month 20% out of the money put option. That's actually quite cost effective, so it doesn't fully cover the cost of that 5% out of the money put. So then on the opposite side of that, we're selling a 3-month out of the money call option. And that moneyness is going to vary just based on the markets, the level of volatility, and ultimately what the strategy is going to provide is diversified exposure in the market that is going to be hedged. And again, thinking about comparing this to a 60/40 portfolio. So seeking to outperform a 60/40 and do so with lower vol. You will cap some of the upside exposure, which is typical with a hedged equity. For reference, historically, it's about a 5% cap on quarterly performance because these are 3-month options. So thinking about that on an annualized basis times four, that's about 20% total equity market return in a year. So not capping all your upside, but if equity markets have a big run up, you might not realize fully on the upside. But again, the purpose of this is to protect on the downside. The one thing I might mention too, because there's quite a few hedged equity solutions in the marketplace, one thing that we do that's a little bit unique is that we ladder the callers on this. Some of the research that's well known in the industry, I think we have some stuff on our website as well. We'll talk about rebalancing timing, sequencing risk. And so when you're putting these options on where the market is very dependent on the experience that you have as an investor. And so rather than just having one caller on, we're rolling these every single month. And so we're essentially reducing the sequencing risk and laddering or kind of diversifying those callers to help the overall experience. So performance has been quite strong, as mentioned at the onset. Right now, Morningstar has a four-star rating. And you'll see some of those results on the far left, and that's relative to a 60/40 portfolio since inception. 25% less volatility than a 60/40, with 2% excess return on an annualized basis. And you'll see that max drawdown has only been about 11.5%, whereas a 60/40 has had about over 20% max drawdown. So you can really see the benefits of having this in a broader portfolio, especially entering the third year of a bull market and just having concerns around some of the broader macro narrative.
The bearish bond guy that I grew up to be obviously likes a hedge like that when you see equities running the way they have the last several years.
Yeah, that's why we need you around. You got to balance the rest of us optimists. And then lastly, and we spent quite a bit of time on this on the last webinar, is our barrier income strategy. This continues to make waves. We get a lot of inquiries on this. I talked earlier about how Foxy is a bit of a unicorn from offering several different objectives. SBAR does as well. We have a 30% drawdown barrier in this. We're selling barrier put options. So you're protected down to 30%. But the distribution rate is really kind of the focus of these strategies. These are really modernizing what has legacy been structured notes. Simplify was the first to bring these to market in an ETF wrapper early in 2025. For those of you familiar with the terminology of being auto-callable, that is a key feature of this. We have the auto-callability on these options that we're selling. It's going to be on the worst of. So the underlying options are it's a worst of basket of the S&P 500, NASDAQ, and Russell 2. I found it fascinating in just the last couple months. I've been having conversations with clients, and when they ask for the features and the structures that we put into this, being auto callability, the worst of those three kind of generic US equity indices, oftentimes it's met with, that's exactly what I'm doing in my structured notes. And that was very intentional. When we sought out to launch this strategy, we wanted to understand what was typical in this marketplace because we really wanted to bring something to market that we knew would resonate. So really attractive income right now. SBAR's distribution rate is north of 12%. We always caveat with the fact that we launched this at a very opportune time when vol levels were high and the premiums that we were earning from selling these options was a little bit elevated. Over time, as volatility subsides and some of these kind of legacy contracts roll off, target distribution rate may be closer to 10%. But really attractive for any advisor who is using legacy structured notes. The common concern or headache that we hear about is the operational intensity of these. You're constantly having to roll these every time a contract is getting called, the customization, having to structure all of these. So the fact that we have this in an ETF, it's diversified. Right now, we have just shy of about 40 underlying different options. So you can think of that as almost 40 individual structured notes wrapped into a single daily liquid ETF. We have a lot of information on our website about this. Our chief equity strategist, Jeff Schwarty, actually just joined a very well-known podcast to talk about this as well. So really excited and definitely on the forefront of innovation. And we've seen quite a few of our peers bring similar strategies to market. So I'd be happy to have conversations with anyone of interest that would like to understand the differences, the nuances, and why we think SFAR is a really attractive addition to income portfolios and for any of those investors that are using structured notes. So with that, um, I will pause. Jason, did I miss anything? Is there anything else we want to talk about before we field some Q&A here in the last couple minutes?
No, I think we covered it all. I think that was a great recap of everything on the agenda.
Cool. Brian, do we have any good questions?
Yes, we have a couple. So, regarding CTA, number one,
Yeah.
why do we not have currencies in CTA?
Because we have Foxy. Kidding. Very intentional construction decision at the onset. Ultimately, what is going to happen in a trend following perspective is that if you add currencies, the model is going to favor the higher yielding currencies like EM, which brings on a lot of volatility. And so you'd have to essentially constrain the model to not favor higher yielding currencies because it's going to be looking at the carry profile. Another reason too is over the long term, we found that the model that Ken employs in Foxy is actually more productive from a return performance perspective, whereas long-term trend within currencies, there's some mixed research on that. So it's really primary reason we've excluded is for the first reason I mentioned, is to be that most capital efficient diversifier and reducing equity beta.
Okay, and then Paisley, you've done some work here. Thinking about a 60/40 portfolio, looking to diversify away. What are some, potential, target weights for something like CTA? The question is to produce positive results in a negative stock market. Obviously, you can't predict what
Yeah.
returns for CTA would be, but just give a little bit of commentary on diversifying with something like CTA.
Yeah, I'm gonna try to be as explicit as possible without like not answering the question, right? It's gonna be dependent for everyone. I'd say anything less than 10%, and it doesn't have to just be a CTA. I'm talking primarily about whatever your diversifier liquid alt sleeve looks like. If the correlation of that is, zero point 0.6 or zero point 0.7, it's not going to be as punchy when you have those equity market sell-offs because it does carry some beta. So if you really are talking about a negatively correlated asset like CTA, you can get away with, say, 10% of your portfolio and actually have meaningful results to reduce overall portfolio vol. And if you go to our website on the CTA landing page, our flyer has a visual where you take a 60/40 and you carve out 10% to just CTA. And the results aren't going to blow your mind. I mean, we're not doubling performance by any means, but it's really those tweaks at the margin that I think help in client conversations. And I would say 10% slug out of a 60/40 with a negative correlated asset will definitely give you enough of those results that you'd be looking for.
All right, good stuff. Thanks, Paisley. And
Yeah.
then Jason, how will the Japanese government bond yield increases on the long end impact US longer term rates? Any thoughts there?
Yeah, we've obviously seen it. Obviously, over the last few days, we've heard this, seen the headlines, and that was part of what was pushing up longer end US rates. Obviously there's the Greenland, the Fed, independent stories that have been going around as well that have pushed up long-term US rates. But, you know, Japan's in a little different situation than the rest of the countries. They're the one who's been sitting at that zero bound forever. They're in the hiking mode where the rest of the central banks are all easing now. Obviously, the Fed is still higher than most of the others. The ECB's, obviously cut quite a bit along with the Bank of Canada. They're down in the twos. So I think there's that impact. Really, what I think it tells us as a government, especially Congress, that we probably need to get our act together with get our fiscal house in together because we can't keep kicking the can down the road on this deficit we have. And so yeah, it's going to have a near-term impact on longer-term U.S. rates, but what it really should do is polarize the Congress to get their act in order and start trying to do something with our deficit.
There's a
I'm seeing another
question.
question on here. I have it pulled up now, Brian, on thoughts on possible alternatives for an all equity portfolio, noting that CTA performance, obviously, over the equity bull run we have, hasn't kept up with equity. And I would say, going back to one of our recent launches, that's exactly why we brought CTAP to market, is that you are going to get that equity beta plus the diversification on top of it. So CTAP would be a great solution for those that are looking to kind of keep up with the equity markets, but still want some of that diversification in the portfolio.
All right, and then there's question here on Foxy. How do you think about, and I'm going to kind of reword this, but how do you think about Foxy in terms of kind of its risk profile relative to an overall portfolio, and any commentary on yields for Foxy?
Yeah, so Foxy is actually levered up from, it's about a 5% vol that we lever up to achieve about a 15% vol target. So just for reference, and that's kind of equity-like volatility, historically, rough estimate, of course. So I would say within a total portfolio, because it does have a lower correlation, especially to bonds, but even to US equities of about zero point 0.4, incorporating that, even though it has a 15% vol, is going to help to reduce overall portfolio volatility if put alongside just kind of traditional equity beta.
There is a question here on how did hedged equity perform last year? I'm going to try and pull up a chart here. I think you guys had Q4 performance in there, but I want to just kind of show this. Is that working?
Trying.
It's loading.
There it is.
All right, so this is a look at hedged equity last year versus the 60/40. What we expect from hedged equity is for it to have about a 0.5 beta to SPX. So in a market where the S&P 500 is moving up like we saw last year, we would expect to underperform in that market. But overall, full market cycle, we would expect to have kind of lower volatility, and solid absolute returns.
Perfect. I think we're a little over time as well. So maybe any other questions we can follow up via email. Just want to be respectful of people's time, and I have to catch a flight to Seattle. So thank you, everyone. Thank you, Jason. Really appreciate your
Thank you.
insights on fixed income. Hopefully everybody found this helpful. It just seems to be very topical given where we are in today's environment. All of us here at Simplify are happy to answer any additional questions, here to be a resource. If you'd like to speak directly to any of our sub-advisors on our list of strategies, we mentioned Altus Partners as one of them. Please don't hesitate to ask. And we would just like to say thank you for your continued support. We're happy to continue to bring innovative solutions to market and be as transparent as possible and continue to deliver alpha. So cheers to 2026, and we will see you guys next quarter.